Hello and welcome to this Wednesday's morning market briefing. We've got lots to talk about, but firstly, China's export curbs on semiconductor materials stoke chip output fears, as well as that Exxon warns of oil shock if suppliers assume demand will fall by 2050. We've got lots to talk about on the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with Chinese semiconductor materials. Now, the new Chinese export control on key chip materials are now hurting critical supply chains and thus stoking new fears of potential shortfalls in Western production. This comes as Beijing limits the shipments of materials like germanium and gallium, which are used for semiconductor applications, as well as military and communications equipment components. Now, of course, this is a very key topic to cover, especially amidst the AI revolution that, of course, is seemingly taking place, which heavily relies on these latest chips and therefore the chip materials which they so desperately need. And any kind of news regarding how that might affect the supply of such chips or the demand of such chips is always something that we're covering on this channel, as we've been recording much of the kind of rise of Nvidia over the past year or so, with Nvidia's stock rise being something to awe at, and obviously the kind of moves that we have seen with Nvidia have stoked other fears of a potential bubble within the AI scene. But we're not talking about that today. But why I'm talking about Nvidia in particular is, of course, it is that kind of it is the semiconductor manufacturer that, of course, underpins this entire AI revolution. That's why we've seen its rise to the upside in the stock market, and ultimately, therefore, it depends massively on these key materials. And we do know that there's a massive demand for those latest Nvidia chips, with Nvidia seemingly over the past year coming out with just chip after chip after chip. And of course, we know that orders are still being fulfilled for those chips even a year on after those orders were made, just because of the kind of process that it takes to actually manufacture these chips and then export them, and for them to reach their final destination, obviously, and how that affects the way a business might function and what they're maybe then thinking for which chips to actually order, because of when they kind of want to make a switch to a certain production line or whatever. Ultimately, this is a massive topic, as I've said now many times, and it's going to be very interesting to see how the kind of supply of chips does change as a result of these kind of increased export curbs. Now, the kind of Chinese trade topic has been a big one over the past year. As we know, there's kind of been increased hostility between the West and China regarding trade. And this has largely been stoked by fears of kind of dumping and, certain subsidies, especially on the EV side of things, certain subsidies with the EU, which the EU believed that, China was essentially using subsidies to boost their domestic EV manufacturers and therefore, get lower costs and lower prices, therefore, to export their kind of cars into, the Western world, and how it was affecting Western markets. And therefore, the EU has launched their own investigation into that, and China's kind of responded with their own kind of investigations. And with that, we've seen many tariffs applied. And obviously, this is a massive issue for international trade, and it kind of represents this growing, division across the world, where we have this rising economic power that's affecting markets greatly, and we have the Western powers of the world, which ultimately want to maintain their share of the market. And so it's going to be an interesting thing, to kind of keep looking at, to see how, of course, EU or the US or Britain or others around the world, especially in the Western world, deal with this growing issue. And this issue in particular, the topic of Chinese export curbs on semiconductor materials was directly triggered, of course, by the US's own kind of curbs on exports and imports, and how China's then kind of retaliating to that is by implementing their own export curbs, which they hope will affect the supply chains that we're talking about, and therefore will force the US into a kind of new position to negotiate and decide what they actually want to do regarding semiconductor materials and just the topics of chips. So this is definitely something we'll keep you should keep your eyes on, and we'll keep you updated on, as things do kind of will not escalate, but ultimately become very interesting, with the latest restrictions having caused the price of these minerals in Europe to nearly double over the past year. China initially introduced these restrictions out of fears for national security, with their reason being that they wish to safeguard their own interests following the US's own control of sales of advanced chips and making equipment, and of course, those US controls were also based upon the fears of national security, because ultimately these latest chips, many are worried that they're going towards kind of key weaponry, that they would be used against one another basically. So that's why these kind of export bans and import bans are being introduced to kind of limit the successfulness of these attempts to build better weaponry or build kind of these chips basically in one another's nations. So we'll definitely keep your eyes on that, specifically that kind of more foreign policy side of things, the more defense side of things, which is very interesting to kind of analyze. These recent controls implemented by the Chinese government are already having a devastating effect on key industries and supply chains. This has ultimately done a very good job at highlighting Beijing's continued dominance in the supply of dozens of crucial resources globally, with the country producing 98% of the supply of gallium, and also 60% of the world's germanium. People within industries affected by the recent export control have said that overall exports have fallen by nearly half since the controls were implemented. So obviously that's a massive kind of drop, and it's very it's quite crazy to think that 98% of the world's supply of gallium is ultimately produced in China. And if we're thinking about conflicts between the US and China in the future, or just conflicts with China involved, we have to think about how that might affect the export of such materials. And when wars take place, as we've seen with Russia and Ukraine, you have to think about how that affects global economies. And the Russian invasion into Ukraine had a massive effect, of course, on the European economy, even the global economy. And so that's something that you should definitely be thinking about. Next article to talk about, though, is to do with Exxon and the topic of global oil demand and oil supply. Now, ExxonMobil has now warned that global demand will remain nearly unchanged by 2050. This provides a stark warning to governments and industries around the world that essentially any move to curtail investment into fossil fuels will trigger an energy price shock. Now, obviously, we're always talking about oil on this channel when we can, as it's a key asset and commodity that, of course, is traded on the financial markets. It's the one that we actually look at on TradingView when we go to it on the chart section of these videos. And ultimately, oil's been in a very interesting, kind of position over the past year or so as a result of the kind of increased kind of tensions that we've seen across the world, but especially in the Middle East, with the potential of now a regional war within the Middle East, as we covered in the last video, being greater than ever. And ultimately, should a regional war take place, as we covered quite some time ago now in a video where I spoke about where oil's price could go should a regional war take place. Certain forecasts and warnings kind of warned of oil's price reaching $150 a barrel should a regional war take place, where the likes of Saudi Arabia and others within the area, especially Iran, of course, get involved. We could see oil's price rise to $150 a barrel, and that's just as a result of that region producing such a great amount of oil and exporting it to the world. So that's kind of been the key topic when we've been talking about oil, but we have also been talking about key forecasts regarding demand and supply, which are coming out every quarter and every few months, which allows us to understand where the kind of world is sitting regarding oil, and even those weather reports as well, which as we head into winter we receive, and we better then understand how much kind of oil be required to heat homes across the US, across Europe, as we do head into kind of the winter period. Ultimately, though, this kind of article does kind of differ from what we usually talk about, where now we're kind of talking way further in the future. We're talking about 2050, and we're talking about, that kind of long-term forecast of where things could be. As ultimately, what they're kind of warning of here is, governments around the world are implementing new net zero policies. They're looking at ways to kind of reduce the consumption of oil. They're looking at ways to kind of pivot away from fossil fuels towards cleaner energy sources, such as, of course, hydroelectric power in some areas, which can utilize such schemes, or even of course wind power or solar power. We've seen a great deal of methods implemented to kind of facilitate this transition. Ultimately, though, what we're hearing from Exxon is demand really won't fall to those same levels that individuals and governments are expecting, and as a result of that, demand's going to stay the same. But because of these cleaner energy policies, because of these kind of initiatives to reduce oil supply, as we've seen, of course, in the UK recently, ultimately that's where we're then going to see an oil shock, because there just isn't the supply to fulfill the demand. And what we see then is, of course, an oil shock where the price of oil and other fossil fuels may skyrocket. And that's kind of what they're warning of here. It's kind of a warning that this could happen at any time over the next 25 years or so, should these policies actually be implemented, and without a proper understanding of where the world is heading. So it's very interesting to hear this news, of course, as it does differ from the kind of mainstream narrative at the moment. And it will be a question of how true, certain forecasts are, because other forecasts, as we'll cover in this article, are very different to what Exxon is warning of, with this forecast saying that oil demand will stay above 100 million barrels a day over the next 25 years. This forecast also assumes that an energy transition will fail to reduce the world's need for fossil fuels. Exxon ultimately warned of a new oil price shock globally should companies continue to fail to invest the amount of money needed to match demand, with them concluding their report in saying that the price of crude oil could quadruple as future supply falls. These predictions do contradict the forecasts of the UK's oil producer BP, which instead expects oil consumption to decline to 75 million barrels a day by 2060. So very interesting comment there about what other key oil producers are thinking, as they are differing greatly from Exxon, for example. That's all to talk about in the articles, though. Next to talk about, of course, is the charts, which is very important, of course, to cover after what we've just been speaking about regarding both, chips and now oil, two things that we're, of course, always looking at on the channel. But to begin with, we are talking about the US 30, the Dow Jones, like always, which is sitting in an interesting spot after kind of a period of bullish momentum beginning since, the start of August. Now, at the moment, we're still sitting at those kind of levels that we started off the week at. If we kind of just zoom in, or even go down onto the 1 hour, you can literally see the price has barely moved an inch. It does seem like since where we started off on Monday. On Sunday we literally were sitting at 41,180, and now we're sitting at 41,228. So really not much of a move has taken place over the week so far, over the past 2 days. And the question will be, as we do, reach the kind of midpoint of the week, where will price go? Will price kind of reverse now because it's encountering some resistance to the upside, or in fact are we kind of preparing for a further move to the upside as price does accumulate orders? And that's the kind of key thing that we're asking at the moment. An interesting point to look at, or an interesting point to make, is one that we can kind of see on the RSI, with this kind of bearish divergence somewhat forming now, over this kind of recent period of price action. And as price does kind of struggle to break higher as a result of resistance at these all-time high levels, one does question whether we are now potentially seeing a reversal that's set to take place. It's always important to kind of preface this, though, with the fact that fundamentals always take precedence over what we're kind of seeing on the charts. We're more so looking at the charts, it does seem like, to kind of understand where price may stop off at, where price might react with, where price might find some resistance, in line with any fundamental events that of course come out. So The key thing will still be to listen out for news from Jackson Hole, news from, kind of the key central banks, of course the Fed most importantly, and also key economic data from any US agency. So that's the kind of key thing to look out for. But at the moment, the US 30 is in a bit of a predicament where potentially it's preparing to reverse to the downside. Next to talk about though is the dollar, which is pushing lower still, as we've seen since the 15th of August. Now at the moment we are kind of forming this mini double bottom. This is kind of what I've noted it as, but of course it's hard to tell what the kind of situation actually is for the dollar, just simply because this is a very small piece of price action, and you can only really notice it properly if you kind of zoom in on the 1 hour. But what we can note is that the dollar is down very much to the downside at the moment, and is now in the process of breaking below lows made around the 28th of December last year. If we go back further than that, we're looking at price interacting with levels not seen since last July, as I noted in yesterday's morning in Monday's weekly market briefing. So really price is in a very interesting position at the moment, where many are now expecting large rate cuts from the Fed, and therefore they're kind of selling off the dollar. So definitely listen out for news from the Fed, as I said with the US 30, as that's really what's going to affect the dollar. Next to talk about is Euro USD, which is currently on the swing to the upside, representing the kind of inverse of the dollar, after, of course, the kind of euro being priced in very weak, as it was the kind of, it did have the first central bank to actually cut rates out of the kind of three key Western central banks that we cover on this channel, that being the Bank of England, the Fed, and the ECB. So that's kind of why we saw this massive sell-off initially during that period, and now we're kind of seeing this swing to the upside as the reverse happens for the dollar, and as a result, price, as I said, is encountering levels not seen since July of last year, which of course is massive news for the euro and represents new strength for the European currency. The question will be, where will price stop off after this long bullish rally that's seemingly taken place over the past month? And should we now head into September, are we ready for a retracement? Are we ready for a reversal? We just don't know yet. But the point is, over the past week, we haven't seen much price action, and price is still sitting at these all-time high levels. Well, not all-time high levels, but recent high levels. Next to talk about is pound yen, which remains within this range that I drew out to start off the week. It does seem like this is the kind of range which price is kind of accumulating orders in, or distributing orders in, as of course it prepares its next move, as a result of the kind of recent volatility that we've of course seen in pound yen over the past month or two, and that kind of volatility always ends up creating this situation within the markets where the price slows down. The markets become more choppy as they kind of do find themselves in this new uncharted territory. Next to talk about is Bitcoin, which, as I was kind of making this morning market briefing, has kind of crushed the downside but then wicked back up to the upside, as of course last week we were sitting within this kind of price range, and even the week before, we were seeing price sit within this price range and kind of bounce within its boundaries. But ending off last week and over the weekend, we saw price spike to the upside, as I covered in the weekly market briefing. But since the start of the week, we've actually seen a great deal of bearish volume kind of enter the market, and as a result, price is now down and around the very bottom of that old range and period of consolidation. Next to talk about is gold, which is at those kind of near all-time high levels. Recent highs were of course those all-time high levels up and around the $2,532 an ounce, and now we're kind of sitting around the 2,525 level. Of course, on the 1 hour, it's easier to kind of note this price action that we're seeing play out with this kind of area of support and liquidity, because it has been an area of resistance before, kind of being utilized as an area for liquidity, basically, for price to move to the upside. The question will be whether price can find the strength to break above those recent all-time high levels. Next to talk about, and we'll lastly talk about, is of course oil, which we covered in the second article, where price is currently sitting around the $80 a barrel level, as kind of the markets do price in the current risks in the Middle East, but also those recent comments from Exxon. But that's all to talk about on oil. Definitely keep your eyes on it though, as the kind of news from the Middle East is having a massive effect on the price of oil. But we've got lots in the articles. Next about is the economic calendar, where some interesting things are of course playing out, but not too much data coming out today. So firstly, we're seeing the Aussie inflation rate reading, followed by that we're seeing Fed official speeches, and then followed by that we're seeing the French consumer confidence figure, followed by that we're seeing US mortgage data, and that's kind of all for the day really. But we've covered lots in the articles, lots in the charts, and lots in the economic calendar. Hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.